Greetings and welcome to the Superb Diamond Range podcast. This is your host, Superb, broadcasting from sunny Edinburgh in Scotland. Today's episode is number 49, and we have Frank Vasquez Jr. of Risk Parity Radio. I first came across Frank via the Diversify podcast, and he's been explaining about the different types of assets that you can get in your retirement portfolio or portfolio in general, that different ways to diversify and that sort of thing. So it's really interesting. I'll just do a very quick disclaimer. Obviously, we're not financial advisors, so the advice wouldn't be the best. So I'll put a financial disclaimer in the notes of the show. So please do check through this, and if you do require advice, just go to a financial advisor or planner. Welcome, Frank, to the podcast. How are you doing today?
Thanks. I'm doing quite well.
Excellent. Well, I just wanted to start with a quote that I found on your website from Ray Dalio. I think it's from Principles. The holy grail of investing is making a handful of good uncorrelated bets. It is the surest way of having a lot of upside without being exposed to unacceptable downside. So I thought that was quite an amazing quote. What do you think of it?
Yeah, it really is one of the foundations of what we do over there at Risk Parity Radio. We call that the Holy Grail principle, and I think it's something that is a little bit neglected in most portfolio construction, but really has been around long enough that it's kind of ready for prime time as far as do-it-yourself investing is concerned, and is something we ought to be paying attention to when we're constructing our portfolios.
That's great. Can you tell us a bit about yourself and your background, and obviously what got you into risk parity and investing?
Sure. Professionally, I'm a lawyer, a recently retired lawyer, or mostly retired lawyer. But my background prior to that, I have degrees in engineering and economics from the California Institute of Technology. And so I've always had an interest in investing and portfolio construction and those sorts of things. Where I really started thinking about this was after the financial crisis in 2008. Before then, I just kind of dabbled and took standard advice about investing and accumulating assets. But when that occurred, I had a large portion of my bonds in what are called TIPS, or Treasury Inflation Protected Securities, based on the advice I had read in a book by an economist. Okay. And that turned out to be not a good place to have your money in a downturn like that, because they also went down with the stock market. And that sort of piqued my interest as to, well, what kinds of assets would actually save you or do better in that kind of environment when a stock market is crashing, and which led me to do a lot of research about various attempts at that, going back to something called the permanent portfolio in the 70s and 80s. And then Ray Dalio at Bridgewater had started that kind of research in the 1990s, which then developed into what was called risk parity style investing. And there were a lot of articles published in the early 2000s about that. And so for the past 10 years or so, I had been tinkering with various portfolios and then finding more resources online to help me construct these kind of portfolios. And that led me last year, after I retired, to start this podcast, because it was just so interesting to me that I thought I'd like to share it. I didn't realize it was going to be as popular as it's turned out to be, but I'm grateful for anybody that's interested in it, because it is kind of a nerdy topic. But that's
yeah. I mean, you don't really find out. From. Yeah, you don't find much information about it unless you really go digging, and quite a lot of the podcasts that are out there don't always talk about it. You do get it in books here and there, but yeah, it's not something that you hear very much about, and it's very interesting to kind of know about it, because it's something that you have to think about one day, and it's kind of I find it very interesting how it all works. Actually, when I first got interested in investing, I read the book Failsafe Investing by Harry Brown. So I just wanted to get your opinion on the permanent portfolio strategy. I never went through with it, but I was always interested in learning about it because I heard so much about it.
Yeah, that's kind of where I started around 2010, looking at that right after the financial crisis. That actually had sort of had a renaissance. It became popular again. And Harry Brown constructed it kind of in the aftermath of what went on in the 1970s with inflation and gold going up, from $35 to $800. I think it was kind of a primitive stab at what Ray Dalio eventually developed. And because what Harry Brown was trying to do was take different asset classes that would do well in all kinds of different economic conditions and put them together. But he didn't really have much data or any way to analyze it. So what he did was kind of crude. It was just, 1/4 in gold, 1/4 in stocks, 1/4 in long-term treasury bonds, and 1/4 in cash or money markets or short-term treasury bonds. So it was sort of like, a good try, but it really didn't do what it was advertised to do, and you saw that if you held that portfolio in the 90s and the early 2000s, because it was just kind of overweighted in gold and probably on the cash side. And so it's a very conservative portfolio, but you can do better, essentially, is where you come out. It was interesting that it did gain repopularity right after the financial crisis because the price of gold had been going up and continued to go up. And so people became more interested in it. And there was a new book written by, I think the guy's name is Craig Rowland, and he wrote about the permanent portfolio.
Yeah, I bought one of his books
at that stage.
Yeah, he's quite good. He's very good about it. He did a good book about the permanent portfolio as well.
So that was kind of a starting point, but I thought it's essentially a primitive stab at what became risk parity later on. I have the 1989 version of that book on my shelf, though, from Harry Brown.
Oh, wow. Great. Okay, so for someone young who is investing or saving and investing and in the accumulation phase, it's typical for them to be 100% in global equities, typically in the UK, maybe in America, it'll be all in the US total market. At what stage is a good time to think or time to take action and start thinking about switching a portion of your portfolio into other types of assets?
Yeah, there's a couple of reasons that you might switch. First of all, I think when you're first accumulating, you really need to think of yourself as holding this big pile of future cash, because that's all you have. You have the money you're going to make in the future and invest, and so that's why putting it all into stocks right away makes sense, because essentially you've got all this cash that needs to get working for you. When you get to the other end of this, what really is the triggers for deciding to change your portfolio are a few things. One is, do you plan to stop working and living on this money? That's the critical juncture is, well, I'm going to actually start drawing down on this portfolio. So I don't want an accumulation portfolio anymore. I want something that I can be comfortable drawing down on for a long period of time. And so some years out, a good rule of thumb would be like 5 years out, you would really want to sit down and say, all right, well, this is the kind of portfolio I want to have, and then move to that. The other thing you need to take into account, though, in that kind of construct is evaluating what are your expenses. And you can still use what's called the 4% rule to get a ballpark figure as to how much you need. If your expenses are 50,000 pounds, euro, or dollars, and if you multiply that times 25, you get a good estimate as to how much you'll need. And so the question becomes, well, how close are you to that figure? because that figure for you represents essentially winning the game. And once you've won that game, you can take some of your chips off the table, essentially. So if you got to that position and where you had your expenses times 25 and it's $1.25 million, I guess, you could take that part of it and put that into a risk parity or other retirement style portfolio. And then you can continue to work or invest or do anything else you want with the rest of your time. Yeah. But that you have built what you might call a fortress of solitude that is sitting there ready to go. Because for most people, they don't just want to stop working based on just how much money they've accumulated. They have other goals in life. Maybe they still like their job. Maybe they want to work on something else. But that's also a good place to think about that. There's a couple other places where you might think about this. One is psychological, that if you've accumulated a lot of money in an all stock portfolio and it's just making you nervous, it's better to convert that into a more conservative portfolio and just take a little longer to grow it than it would, because the alternative is, if it's going to drop, which it will do periodically and randomly, and you don't have the stomach for it, the danger is that you're going to sell out at a bottom, which is what you just can't do. If you are going to hold a 100% equity portfolio, you have to be committed to riding through those downturns, and they could take 10 or 13 years in worst cases. So that psychology, if you just can't, you just have this big pile of money and it keeps you up at night, then you would be better off converting some of that earlier and then just thinking, well, this won't grow as fast. It's still going to grow. Sure. You're only giving up 1 or 2% in annual average growth with one of these portfolios. So that's another factor to consider just as you're going along and looking at what you've accumulated. And then there's one other thing that you might use a portfolio like this for, which is for an intermediate bucket. Okay. And what I mean by that is, if you're saving for, say, a down payment on a house or some large purchase in 5 to 7 years or 5 to 10 years, this is a good kind of portfolio to put that money in. Yeah, because absolutely. It will continue to grow, but yet it's likely only to have a drawdown max of about 20%, and the length of it's only likely to be about 3 years. So you can have some confidence that you can take some risk there without going whole hog on it, and that I think is a good use for younger people for this kind of portfolio, because there's always a difficulty that I've seen on boards. People think, well, I got this short-term money, maybe my emergency fund, and then I have this long-term thing that I'm going to retire on, and that's over here. But then what do I do in the middle? And this is a thing you can do in the middle that is reasonable, that will fit your lifestyle. So you're not in this all cash or all stocks kind of thinking.
One or the other, sort of. Yeah.
You want to get out of that and think more broadly and creatively about what you might do in that intermediate term investment.
I had a friend that, I'm really happy he got into investing, but one of the first things he invested in was gold. And obviously during the sort of pandemic, there was a point where it was starting to go up. And I think he was a bit annoyed at himself that the time that he bought it was, not probably the best, but he was still glad that he bought it. He's not sold it since. But I just wanted to say that I noticed that through different time periods, certain assets perform better than others. Would you say making the right choices is vital? Would you agree with that sort of?
Yeah, well, what I would agree with is that if you're going to hold a portfolio like this, what you're trying to do is have something that will perform in every economic environment, and not try to predict the economic environment and pick the asset, but just simply say, well, I just want things. So whatever the economic environment is going to be, I'm going to have something that's going to do well in that environment, even if the other things in my portfolio are not doing well. And that's really the idea behind this Holy Grail principle. that you always have something that's lagging, but you always have something that is doing well. And I mean, gold is one of those things that does well in kind of odd environments. Some of them are inflationary and some of them are deflationary. The theory behind it is that when what you call real interest rates are falling, which is the difference between the nominal inflation rate and what's called the growth rate. So if you have a situation like the 1970s where you have inflation outstripping growth, that's a good environment where gold does well. If you have an environment like the early 2000s, that first 10 years there, what was happening there is that growth was falling faster than inflation. So you still had this negative real interest rate situation, and gold did well in that environment as well. It's extremely unpredictable as to sort of when that storm cloud is going to come. And so so gold can be either the very worst asset for decades or the very best one, and you don't know which one it is. That's the thing about it. It's an extremely difficult thing to predict, and I can see why your friend is frustrated, but that if you try to trade gold, you will get very frustrated because it never behaves the way you think it might or somebody think it might. And there's a lot of stories about gold. Either it's going to go to $5,000 or $10,000, and you read these doom and gloom people, and then on the other side of it's like, how could you hold this worthless metal? The fact of the matter is, it's a conservative thing to hold as part of a portfolio, and usually not a terribly large part, but significant.
So Frank, with you being a citizen, a resident in the USA, do you mainly invest in USA indexes, or do you have some international exposure? And can this, if you do have some international, can that help to diversify further your portfolio?
Yeah, we're in an interesting world these days. That when I look at the way technically to do this is to get out what's called a correlation matrix. Unfortunately, you can find this online for free if you go to what's called Portfolio Visualizer. At least in the U.S., I realize it doesn't have all of everybody's the funds available on there, but the idea there is you go and if you're thinking about investing in things or constructing a portfolio, you put all those tickers in that calculator and it spits out and it tells you which ones are correlated with other ones. What I found in recent times is that your large international funds, or these global international funds that hold the largest companies in all different countries, seem to be highly correlated with the large U.S. funds. So you're not getting as much diversification there if you're a U.S. investor as you used to, and therefore it's kind of frustrating in a way. I keep wondering why that is. I think part of it's globalization, and part of it's the fact that what's traded on international stock exchanges in a given country often is not reflecting the economy of that country, but just some particular industry. So if you buy Canadian stocks, there all these mining and financial and natural resource things. Same thing with Australia. That's not the whole economy of either one of those countries. I'm tinkering with that, but I'm looking for funds that show a very low correlation with other international funds and other U.S. funds. The most recent ones I've set upon or looked upon, there are some funds now that invest in the broader Chinese economy, what are called the A shares that are traded, and these are essentially domestic Chinese companies that do most of their business in China. And I've seen on correlation matrices, those have very low correlations with the rest of your common world stocks. So those are something that I've put a little bit of money in. I'm still, I'm not sure they're necessary on the U.S. side because the because the companies are global, the real big ones. Apple is selling stuff all over the world.
Absolutely.
Coca-Cola is too. All these, all Microsoft, all of those are operating all worldwide, so they kind of cover that set of things. But I would be interested in finding more funds that actually invest in the domestic economies of various countries, particularly the growing countries. They just don't exist for the most part, because in a lot of countries, the domestic economies are run by private companies. They're not run by traded companies. And so, it would be great to find a fund that was the domestic economy of Nigeria. You can imagine that is growing, but there's no way to capture it in a fund that we have access to right now. Or India. There really isn't a good way to, like these Chinese A shares. If you had something like that for every country, that would be a more interesting diversification play. So for me, this is an area of some frustration, because when I look at those international funds that people commonly invest in the United States, there doesn't seem to be a whole lot of point to them in a risk parity style portfolio, because you're just not getting any diversification. They're 90% plus correlated. And so when you have two things that are 90% plus correlated, you might as well just pick the one that you like the best and not have this kind of false diversification where you just have more and more of the same things. I mean, I've said to people, it's like when you go shopping, you don't want to like just pick all pieces of meat and that's all you bring home. You want some vegetables and bread and other things to make a meal out of. And when you look at some of these international funds and compare them to the U.S. counterparts, some of them are like, well, that's just more of the same thing. And so that's what I'm always thinking about when somebody suggests something, well, how does that play in the sandbox with the rest of the things I already have? Is it really different? Is it really adding anything? Or is it the same? And then if it's the same, is it better than what I've already had? Should I, get rid of what I have and put something else in there? With these large international funds, I haven't found any real extra value to them in most cases.
So obviously, I'm being from the UK. The typical advice for us is just to invest globally in a global index. Obviously, about 50 or 60% of that is the US, and the rest could be emerging markets, Europe, that sort of thing. So there is something that a lot of UK investors face in regards to currency risk. Just wanted to get your thoughts on that, because this can be an issue for UK investors, as our home currency is obviously in the British pound. So just wanted to get your opinions on currency risk. What your thoughts are?
Yeah, I mean, I'm certainly not an expert in that area. Given
it's quite easy for Americans in
the exorbitant privilege of using the U.S. dollar, which is the world's reserve currency. I've heard that advice. It seems like sound advice to me, that most international investors are underinvested in the world and overinvested in their own country. There obviously is going to be some of that currency risk. Some of that actually is ameliorated by investing in gold, because gold acts as another currency on the side, and it is not dependent on the performance of any particular country's currency. So that I think is a defensive way of dealing with that. I think the other way for people in the United Kingdom, I don't know how much. I mean, how large is the UK's economy in the world?
6% GDP.
6%.
Yeah, it's very small. Yeah.
Yeah, I can't do any better than the advice to invest, in the world, in a kind of a balanced way. That I mean, I know that's the common advice that it's given, and I cannot say I can improve on that advice for this. Yeah, I think where it may make even more of a difference is on the bond side.
Yeah,
And
that's
that's
totally makes
something I have
sense.
not really analyzed as to whether it's better for a for somebody in the United Kingdom to be holding just you still call them gilts or
Yeah, yeah, that's right. Yeah, you got it.
not consoles like the time of Napoleon. But whether it's better to hold, I think it's better to hold some domestically, but then again, you're looking at these ridiculous interest rates for European bond issuances that are much lower than U.S. dollar
Yeah,
treasuries. So it's it's the safer thing would be to hold some of each, I think.
definitely. Because there are some people that invest in like global bond funds, but that are hedged to like the pound. So that's
Yeah.
another way. But obviously, sometimes they can be a bit more expensive. The fees. But yeah, that's one way. And some people trust that more than their own country sort of thing. But yeah, it's quite interesting. I note from your website, Risk Parity Radio, that and also the podcast, that you have a few different test portfolios. Which of them would you say has performed the best so far, and why?
Um, well, they've only been live since last July, so it's
Okay,
it's a
so it's
it's a,
still
it's a
quite early.
tiny data sample. Although you can run these back on back testers, portfolio visualizer and portfolio charts, and see a much longer time frame. In the current environment, the one that's doing the best right now is called the Golden Butterfly,
Oh yeah, I've heard of
which
that.
was
Yeah,
designed by the guy who his name is Tyler, and he operates the Portfolio Charts website.
yeah.
And but the golden ratio portfolio is right behind it. They're pretty similar. The reason the golden butterfly has performed well recently is because it has 20% in small cap value funds.
Okay.
And over the past 10 months, those are up 80%, something like that.
Wow.
So I mean, which is interesting because that has been a laggard for a decade,
Okay.
and it was only recently that you get what's called a rotation, and people have been saying, well, for years this is gonna happen. Of course, it didn't happen, and so it's been funny. If you had one of these diversified stock portfolios over the past decade, it probably performed worse than somebody who just threw it all into some total U.S. market fund.
Yeah.
But what you're seeing here is, as conditions change, different parts of these portfolios perform better or worse. And since that one has the largest of the sample portfolios, that has the largest component that is purely small cap value, that's why it's done the best recently.
Which has performed the worst and why so far?
Let's see. The worst one so far, it's because it's designed to be very conservative. It's called the All Seasons portfolio.
All right.
And
Grail, when is it?
Yeah, I only put that in there because when people hear risk parity, unfortunately, that's what they think is a risk parity portfolio.
Yeah.
What that is based on Tony Robbins did a book, I think, called Money Master the Game. And in that book, he interviewed Ray Dalio. And he asked Ray Dalio, well, what kind of portfolio would you recommend for, right now? I can't remember when he wrote the book, for just a very conservative portfolio. And so that portfolio only has 30% stocks in it.
Yeah, it's quite low.
All in one fund, and then it's got 55% in U.S. Treasuries divided into long-term Treasuries and intermediate-term Treasuries, and then it's got 7.5% in gold and 7.5% in commodities. So I mean, it's just a really conservative portfolio, and it's up like 7% since last year, but that is in my mind, it's too conservative for most people. But I put it there as a sample portfolio because uh, it became popularized as the quote risk parity portfolio unquote, when really it's just kind of one conservative example of the ideas behind this. So that's the most conservative, the lowest performer. The other ones are all, up around 20% right now since last year. They've had good years, but the stock market has had a good time recently, so that's not surprising. Where things are going to get more interesting is when we see a downturn in the stock market, because that's when these portfollios really help.
Yeah.
By going down less when the stock market is doing badly. They're not designed to keep up with the stock market. They're designed to have the same risk profile as a traditional 60-40 portfolio, at least the three main ones in there. We also have a couple of experimental portfolios using leveraged funds, and those have actually not performed that well so far. It will be interesting to see how they do, but they have the same kind of volatility as the stock market, and so one of them just went up 3% last week, or 3.5% last week, which is a huge move for these kind of portfolios. They're usually less than 1% moves in a given week, because the ideas are supposed to help you sleep at night, not get you excited. But we do have those two experimental ones that I thought would be interesting to have, just as so we have an example of a very conservative one, ones that are sort of in the middle, that are sort of the kind of thing that you probably want to use, that have between 40 and 55% in equities, and then we have these experimental ones with these leveraged funds, which are more there for interest rather than recommendation, because the world of leveraged funds is not that old, and it's not, so you can't really test it going back decades like you can for other ordinary funds and forms of investing.
So I spend a lot of time in the Boglehead forums, and you do get a lot of new investors that put up their portfolio allocation, what they're thinking about investing in, and I've seen a few where they've got quite small allocations to like REITs or a certain type of bond, and it will be like maybe 3% or 5%. And I noticed in the comments that some of the more experienced Boglehead, people that were giving their opinion on the folio, were saying that they felt that you need to make it at least 10% minimum for it to have an impact on on your portfolio. That having such a small amount, you may not see anything with that. I just wanted to get your opinion on, would you say it's important to have at least 10%, to kind of like make it worthwhile, or to make it, to see what it can do, or does it not matter so much?
No, that's a great question, because what that question actually depends upon is the relative volatility of the asset. Okay. So something that is highly volatile. Today we can point to Bitcoin, say. Sure. If you wanted to include some Bitcoin in your portfolio, you probably only want 1 or 2% of that, because it's about 10 times more volatile than stocks or gold or something like that. Yeah. So when you're talking about relative volatility of things, the less volatile it is, the more you would have to hold of it for it to make a difference in your portfolio. So but what they're getting at is most of the things they're talking about have similar volatilities. Yeah. If you're talking about different kinds of stocks or stock funds, they're going to have similar volatility. So that general rule is going to apply when you're talking about things with differing volatilities that are either much less, say, a short-term bond fund, or a very volatile thing like Bitcoin or some kind of speculative commodities fund. Then a smaller portion of it is warranted. I think, though, the only real way to analyze these things is to actually go to one of these analyzers, and then the portfolio visualizer is the most popular one over here these days. There are more coming online, and actually, put in what you think you want to hold, and then look and see how that has performed and how each of the assets have worked a little bit. It's, I analogize it to either, baking a cake or creating a kind of steel, since my background's in material science, that oftentimes you don't know what you're going to get until you actually go make one. and then analyze its properties, because just looking at things in a vacuum by themselves can give you very misleading perspectives as to how it will actually perform in a portfolio. But what makes sense there, and what they're getting at, is I think an amateur investor usually just kind of goes in the grocery store of funds and just starts picking random ones off the shelf. It's like, oh, this one looks good, and this one looks good, and this one looks, and so you just end up with this mismatch that doesn't really work together. And if you haven't gone and analyzed how this thing does work together or doesn't work together, you really can't say much of anything about what this is going to do. I know I'm getting off into a tangent, but it's okay. That the fundamental thing of how I think we should be looking at portfolio construction these days, that we just have more tools and more ability to analyze things than we did before. So we don't need to just kind of guess anymore. We should be doing a little more homework before we declare something as good or bad or useful or not.
So obviously in the UK we have different types of vehicles like ISA, we have pension, defined contribution like 401k in America. So obviously these are tax advantaged accounts. I just wanted to get your opinion on asset allocation, and about it's obviously important, but what your thoughts are on asset location to protect from tax, and how you should factor that into your portfolio and your planning.
Yeah, it's more important in some jurisdictions than others, and it does depend largely on the setup you have and the tax regime you're under. We have some very peculiar rules in the United States about the way things are taxed and how different things are taxed, because we have what's called long-term capital gains if something's held over a year, but some other things also qualify in it, and so that goes to a lower tax rate, but it's also dependent on your other income, believe it or not. So this is an important consideration, but it shouldn't be the tail that wags the dog.
Yeah.
The way to approach it is simply to look at, if you're going into retirement, for example, look at all of your assets, everything you've accumulated, try to figure out how you want that all to work together. And then as you're going along, deal with this tax location issue as one of the last steps.
Okay.
You wouldn't want to start with that. So
yeah, that's a good point.
So in the U.S. context, for instance, a REIT, or real estate investment trust, typically generates what's called ordinary income. So it's a disfavored kind of tax treatment. So you would if you had that and you had some ordinary stock fund, you would want to put the REIT in the tax protected part of your portfolio.
Yeah.
Because it's already generating ordinary income in there, and you'd keep the other thing out because it pays what is called a qualified dividend, which is taxed at this lower long-term capital gains tax rate. Yeah. Which and this is probably putting your listeners to sleep at this point, because it's completely U.S. centric.
But I've heard about it. Yeah.
It is a consideration to make, and particularly if you have a very large portfolio and you expect to have a large income in retirement. because that's the other factor, which tax bracket you are in. If you're in a very low tax bracket, then maybe you don't even care at all. But if you have a significant, if you expect to be taking significant income off one of these portfolios, then that becomes an issue for you.
So quite a lot of the advice that you get within the financial independence movement, is typically, obviously, you could be 100% in stocks, and then obviously as you get closer to retirement or reach retirement, you would then move to what they would phrase in America as a total bond market fund, say 20% or maybe 5%, 25%. Obviously, over here we have the global index fund. We could sort of recreate the total bond market. We don't quite have the same fund, but you can put like a 60% in the UK government bond fund and then 40% in like UK investment grade bonds. That kind of creates like a 60-40 between government bonds and corporates. But yeah, I just wanted to ask that the two fund portfolio, it's obviously simple to manage and everything. Would you say that it's enough these days to kind of like, or should we be looking to diversify more into other asset classes, especially these days?
Well, I think we need to reevaluate the usefulness of what we call total bond funds.
Yeah.
Because they don't actually work as well as some other things in your portfolio. I think there's some bad habits that have evolved over time. And while it was true back in, the 70s, 80s, and 90s, that's when people applied what's called modern portfolio theory, Harry Markowitz from the 1950s, and came up with this 60-40 portfolio as kind of the best you could do. That was all before, Ray Dalio was doing those kind of analyses and all of these papers. And we're, 25 years from that now. And, we should know better, but we're still sort of reaching back and sort of grabbing at these old chestnuts. I like to say, well, we used to have all of our cars had carburetors and and now they have fuel injection, and you wouldn't go out and buy a carbureted car. And in a certain respect, this kind of basic 60-40 portfolio where you just take a total stock market fund and a total bond market fund is like using a carbureted car in the 21st century. So and here's the problem with the bond fund, with a total bond fund. Those corporate bonds in there are probably going to be positively correlated with your stock funds. So they go against this holy grail principle.
Yeah.
And if you have things that are positively correlated with your stock funds, you're not getting diversification, or the kind of diversification that you expect or want from your bonds. If that's the purpose of your bonds is to diversify against your stocks, you want to hold the bonds that are actually diversified from the stock.
Yeah, totally not the same.
The total bond fund has a mishmash of stuff, and it's also kind of a misnomer that a total bond fund actually doesn't include all the bonds in the world. Even a total U.S. bond fund includes basically three things: some high-grade corporate bonds, some what they call Ginnie Mae's mortgage-backed securities, and some treasury bonds. And then that is not all the bonds in the world.
Yeah.
So the better practice these days is not to use total bond funds at all, but to look at individual kinds of bonds. And now we have funds for all of these kinds of bonds, and not only the type of bond, but also the duration of the bond, because the duration of the bond affects how volatile it is and what it's likely to do. So a shorter duration bond is going to perform like cash, which you may want some of, but you don't want a whole lot of, because it just drags your portfolio down if you hold too much cash in it. A longer term bond is going to be much more volatile, but both in your favor and out of your favor. So where you end up in the analysis for risk parity style investing is you do want to have some long-term treasury bonds for two reasons. And they both have to do with diversification. One is they are the most diversified from your stock funds. And so they have a negative correlation. When stocks are going down, those tend to go up in value and vice versa.
Yeah.
The other thing, the why you want the longer term is that volatility, because you actually want them to move in that direction, and you don't want to have to hold too many of them. So, for instance, if you looked at the crash in March 2020, during that time frame from January to March, long-term Treasury bond fund in the U.S., that went up in value 20 to 30% in capital appreciation. It has nothing to do with the interest rate. It goes up in capital appreciation. Wow. If you were holding a short-term bond, it probably only went up 3% or some small amount. If you were holding corporate bonds, they probably went down in value. And so you could see the stock market crashing and your bonds are crashing as well. That's not what you want. So where we're going with this is we just need to be more mindful and judicious about what we're actually choosing and how it matches up with the rest of our portfolio. I think the other mistake that is perpetuated by well-meaning people is the idea that you're going to construct this bond portfolio that's separate from your stock portfolio. Yeah. Without considering, because if you just did that, then you would hold all these different kinds of bonds, because some of them are not correlated with each other. The bond world is much more diverse than the stock world is. But just doing that and not paying attention to how that affects your stocks or relates to your stocks, it makes you create something that is suboptimal. So whenever I see somebody talking about creating a bond portfolio, it's like, wait. Let's talk about your whole portfolio and how all of these things relate, and then pick the kinds of bonds that work well with the other things in your portfolio and do what you want them to do, whether that is, and there are three things that bonds could possibly do. One is diversification, actually perform differently than the other things in your portfolio. The other one is just stability. The short-term bonds do that. They're like cash or a savings account. And then you can get income out of them. That shows that probably the least important thing you can get out of bonds is income, because there isn't much income coming out of them these days. And there are other things in the world that you can acquire that generate income, whether they're REITs or preferred shares or other kinds of things. So you really want to focus on, well, if I'm holding these bonds, what do I want them to do? Are they here for diversification? Are they here for income? Are they here for stability? And those are three different things. And so you want to pick the ones that do that and use that in your portfolio. So it's not just a grab bag of stuff. But that I think is sort of the critical piece where we're going from the old advice of, well, just take a total bond market fund and that'll diversify your stocks. Well, but it won't do as well as we can do now because we know better, or we should know better. And part of what I'm trying to do is inform people that there's a better way. We can do things a little bit better than we did before because we know more, and so we shouldn't be driving carbureted cars or relying on financial advice that originated in the 80s and 90s when we just know more 20 years on about how to do this.
Just in regards to bonds, over here you get the option. We typically use Vanguard, but you'll get like the option of bond index funds, like short, long, medium term. What's your opinion on buying bonds like from the government? So like we get like I'm trying to think. I think they're referred to as TR, and then it will be like the year that it's coming up. So TR 68 is like a long-term bond, but obviously it's a single one, I believe, rather than a fund. What's your opinion on that? Is that obviously more riskier than buying an of bonds, or what would you say to people that buy it like that?
Yeah, that's the old way of doing things, and it just requires more work, because basically then you do need to construct some kind of bond ladder or bond portfolio.
Yeah.
If you look at what's inside, say, a long-term bond fund, it will be holding issuances for, say, from 20 to 30 years.
Yeah.
And then each year, as you move up, it'll buy the 30-year and sell the most recent one to keep the mix in there.
Yeah.
And so if you're going to buy individual bonds, you would want to construct some kind of ladder to do that with. And I mean, and that is another thing. 20 years ago, we really didn't have a whole lot of choices here about having a fund that is focused on a particular kind of bond and a particular duration. A lot of these funds didn't exist, but now you can go out and say, well, I want intermediate term treasury bond funds, and you can find a fund that buys just those and is proportioned the way you would do it if you were doing it by yourself. So we have a lot more options out there. I mean, there are literally hundreds of bond funds now. You do need to be, what you need to be careful about is not buying ones that are too expensive.
Yeah, that's true.
Particularly American mutual funds, the bad old days. Some of these bond funds are charging, 1 or 1.5% to manage a bond, and that's just ridiculous these days. They should be paying, 0.1% for those sorts of things.
Within the FIRE space, there's a couple, Millennial Revolution, I think, and they brought a book out, and they talk about a yield shield, or having some of their portfolio in different types of assets like REITs and preferred shares, as I've heard you talk before. Would you say that obviously they're doing this mainly in the first 10 years of like the preservation stage, which I've heard is quite a risky time, the first 10 years? Can being diversified, can that help you get through that stage? And does that allow you then to maybe up your allocation to stocks again in the future if you get through that? Have you heard that before?
Yeah, I've read that book, and I've analyzed that portfolio. I think it works, but not for the reasons they think it works.
Okay.
And it's kind of a weak part of that book. It is, when you break that thing down, it's a 60-40 portfolio is what it is.
Okay. Yeah, it sounded a bit like that. Yeah.
And one thing they have done is use preferred shares as an income generator in there, which is also a diversifier, and is also something that makes sense for a lot of particularly U.S. portfolios. But the at bottom is just a 60-40 portfolio. The yield is not something that really makes sense to focus on, particularly now that we live in the era of no fee trading. So if you just want to sell a little slice of something because you need the money, you can just do that. So I think this fixation on whether something pays a dividend or how much is masking the big picture, which is what you really care about is overall returns on whatever you're holding, and then how do they interrelate. So and looking at that, you have basically, and I'm recalling the preferred shares component, which is different from most portfolios. That has first of all, a lower volatility than stocks. It's about half the volatility.
Okay.
So that is going to bring down the volatility of the portfolio. It does happen to pay its income in cash for the most part, and doesn't fluctuate a whole lot. But if it kept the cash in it, it would still have the same. If you thought about a fund that it was a preferred shares fund, but it actually didn't pay a dividend, it just kept reinvesting the payouts from that, and the fund grew in value that way, and you sold pieces of it off, it would be the same thing ultimately.
Yeah.
So I think I think it's not helpful to focus on yield. What you should be focusing on is the overall returns of your portfolio and the overall volatility of your portfolio.
Yeah.
Because that is why that portfolio works, not because of the yields, but because of the mixture that they have there, and it is a version of a 60-40 portfolio.
Yeah.
When you break it down.
Absolutely. So I just wanted to get your thoughts on three different asset classes. I know we touched a bit on it earlier, but just to get your thoughts on gold, because going back to, was it Craig Rowland? I listened to a podcast interview with him, and I think one of his advices towards the end was that he felt putting some gold is good for your portfolio and can help you, and he recommended at least 10% if you didn't want to go the full 25% of the permanent portfolio. So just wanted to get your opinion on gold, and if you think it's important to hold that in a well diversified portfolio if you're in the preservation stage.
Yeah, and I've done a couple of podcasts on this, and one that I took a nice analysis that Big Earn did over at Early Retirement Now, and he went back about 100 years and did an analysis of what portfolios were like when you put gold in them, and basically came up with analysis that basically says that about 10 to 15% gold in a portfolio is going to make it perform better. I'm talking about stock bond portfolios, and it has to do with the diversification, but also with the level of volatility that gold has a zero correlation essentially with bonds and stocks, and so it's just doing something different all the time. And this is a very good example of, if you look at gold in a vacuum by itself, it looks terrible as an investment. It's just languishing there for decades sometimes, and then all of a sudden it shoots up at some random interval. But as it turns out, you put a little bit of that in with the rest of your stock bond portfolio, it does smooth out the returns, and also comes up, when you need it. When strange things are happening in markets and people are getting a little panicky, oftentimes, that's when gold has a big spike, and you can sell some of it and buy something else on your rebalancing, and kind of go from there. So it's not it's not something you want to dominate your portfolio. And that was the real problem with it in that permanent portfolio. It's just too big of an allocation, and then dominated the performance of the portfolio, which only had 25% stocks in it, and so was a very conservative portfolio. And if you looked at the price of gold you could tell, I could tell you by the performance of gold whether the permanent portfolio is going to perform well in a given year or not. And you don't want your portfolio to be so dependent on something like that. Most people want the basic thing driving their portfolio, the returns in their portfolio, still to be equities. Yeah. And then these other things are supporting or working with the equities to smooth out the returns over time. And the gold does a really good job at that if you hold it in a reasonable proportion. And 10 to 15% seems to be the magic amount in most portfolios.
In one of the, again, Boglehead forums, I remember there was a guy that brought up that a friend at a barbecue that he was at, a family friend, had advised him to invest in preferred stocks, and his friend was quite gung-ho, and he was like apparently 100% invested in preferred stocks, and everyone on the forum was like, stay away from preferred stocks, they're really bad. Obviously in the examples a bit extreme about going 100% in, but just tell us a bit about preferred stocks, how they work, and what you think of them, what your thoughts are.
Yeah, they work as a bond substitute in portfolios, really, and their purpose is to generate some income and be a little less volatile. What preferred shares are, and I'm talking about a fund, what preferred shares are a company can issue a different class of shares that are called preferred shares. The reason they're called preferred is if the company goes bankrupt, those people go ahead of the common shareholders, the ordinary stock. It's also true that if the rules, and it varies by jurisdiction, but the rule is typically that the preferred share dividend has to be paid before the common shares can get a dividend. That's not universal, but that's typically the way it works. So what you end up with here is something that is a stock, but behaves a lot like a bond. And they typically, a preferred shares fund, although it's been going up in value. So the biggest one here is called PFF, and it holds the preferred shares of hundreds of companies, and they're big banks and companies like AT&T. They're all sometimes utilities and things like they're all gigantic things that you are figuring are going to be able to pay their dividends. A lot of them are banks because for evidently bank holding companies, that's a good way for them to raise money on their structure. That's beside the point for an investor, but just so you know what you're dealing with. So one of these funds is going to pay you these days between 4 and 5%. It was more like 5, 6, 7% in the years gone by. They have actually, PFF has appreciated in capital value, but that has more to do with its comparison with other interest rates in the world. So you'll see that as interest rates fall, the value of preferred shares will go up to adjust its interest rate down. So it's acting kind of like a bond.
Okay.
So if you are looking for something to reduce some volatility in your portfolio, pay you some income, and in the U.S. the advantage to that is taxed mostly at this long-term capital gains rate, because since it's still a stock or considered a stock, the dividend that is paid is mostly what they call a qualified dividend, so it qualifies for this lower tax rate. Okay. So that's one of those things where if you're thinking about tax location and you're a U.S. investor and you've got some preferred shares and some REITs and some bonds and some other things, the kind of income that you would want to keep in your taxable would be these kind of preferred shares, because you're going to get taxed at a lower rate on that income. So they're not magical, but they can do two things. They can reduce some volatility in your portfolio, and they can generate some income for you. They will go down when the stock market crashes, which is actually a good time to buy them.
Okay.
But they'll typically go down about half as much as the stock market in those circumstances, because the reason they go down is because they are associated with a company, and obviously if the economy is crashing, there's a risk that some of these companies may not be able to pay their dividends.
Yeah.
And so that risk comes up, and that applies also to corporate bonds. They tend to go down in value in a stock market crash. So you need to be aware that they're more correlated with the rest of your stocks than a bond fund would be. But they still they're sort of they're in an in-between place, if you will. And that can be useful in many portfolios. That's also something you don't want to hold, a large percentage of you're probably talking about 10% or
sure,
max 15% and something like that.
Obviously, recently there's been a lot of cryptocurrency that a lot of, people like Elon Musk and, influencers on YouTube have been recommending certain coins, and a lot of people, young people are getting excited about them and just jumping on the train for the ride sort of thing. I just wanted to get your overall opinion on cryptocurrency. I know you mentioned earlier that they're obviously very volatile, extremely volatile, but yeah, just wanted to get your take on cryptocurrency.
Yeah, I mean, the answer is I don't know. In terms of obviously what you, because it is a speculation and it's not
Yeah.
a company. It's like gold, but it hasn't been around 5,000-6,000 years.
Yeah.
Um, so so the real question is, um, how much will it be worth in the future? And that value is determined largely about how popular it will remain in the
Yeah.
future and how many uses it has in the future. And I don't know the answer to that question.
Yeah.
The If you are using something like that in a risk parity style portfolio, it would have to be a very small portion of it, like 1 or 2% because of its volatility right now. If it changes in and calms down and behaves more like gold, then maybe you would be able to have some more. But the right now it's a speculation. So for somebody who's in retirement and trying to live off their portfolio, it's not that
Yeah.
interesting.
No, not at all. Yeah.
Because it's just too volatile.
I find
For
it a lot.
somebody who's just starting out or has a long time frame and can throw some money into it, and some people have gotten very wealthy off of it.
Yeah, exactly.
And so you can't deny that, but whether it will continue that way or how long it will continue that way or where it finally will end up, I'm speaking specifically of Bitcoin, is anybody's guess. It does right now. It does trade like an extremely volatile commodity.
Yeah.
And you cannot say that it does anything in terms of helping you in a stock market crash, because it crashed as well at that time. So you're not getting any real diversification from it. It's relatively uncorrelated because it's so volatile.
Yeah. Because a lot of young people,
I would not count on it in a stock market crash to help you.
Yeah, because quite a lot of young people that aren't even into like regular index investing, they sort of start with that. So that's kind of like their entry into investing. And it's, a lot of it is, like you say, it's just to hopefully it does really well and they'll get, rich overnight. And, it's one of those things that, you do get a lot of people that are interested in it, and there's a lot of hype around it as well, sort of thing.
Yeah, well, it comes from the everybody's got a psychology when they go into investing, and some people, and the funny thing is, people are usually on the ends. They're usually like, I'm going to buy the thing that is going to go up the most, the fastest, and I'm going to ride that pony.
Yeah.
And then other people are going, this is very scary to me. Can I just keep my money in a savings account? I don't want to lose anything.
Yeah.
And the better place to be is somewhere in between that. And what you tend to learn over the course of your life is that if you do get on one of those, trains and it works out for you, it's probably mostly luck.
Yeah.
But if you don't take any risk, then you have a different problem.
Yeah.
In that you just need to keep working because your money's not working for you.
Yeah.
For most mature investors get to the point, it's like, I need to be somewhere in the middle, in something that is going to have reliable growth.
Yeah.
And if we want to speculate on the side with some of our money, go ahead and do that. Part of it is also interest.
Yeah.
Any of these sorts of things. If you want to invest in artwork, that's fine, but you got to go do your homework. If you want to go invest in cryptocurrencies, you got to go do your homework. So I think there's the sort of negative or FOMO style of investing, just going out there and buying things that are popular, is not a good plan for anyone. Yes, you can speculate at things, but please go do your homework and go learn about whatever it is you're thinking about investing in, so you understand the risks involved in it, and then go right ahead. I don't discourage people from trying these things, but just just do it because you've thought about it and have investigated it yourself, and not because your buddy said, oh, buy this today. I saw it on TikTok. I better get in on it.
Yeah. So any final words of wisdom or rules a do-it-yourself investor should consider following that you can give us?
Yeah, sure. I mean, I'll give you the sort of three principles that we work with over at Risk Parity Radio. And well, it's mostly directed at people who are getting to their drawdown phase, but in general, it applies. And one of those principles is the simplicity principle, that don't make your portfolio more complicated than it needs to be. You know, having 10 different stock funds that you haven't analyzed and you just pulled off a shelf isn't going to be any better than having two. And usually, another principle is what I call the macro allocation principle. And this one comes from Jack Bogle's book, Common Sense Investing, chapters 18 and 19. I call that the Book of Jack. And so what that says is that that it is the macro allocations that typically drive your portfolio. So every, say you had a 90-10 portfolio, that's 90% stocks and 10% bonds. The macro allocation principle says that every 90-10 portfolio that is reasonably well diversified within the classes is going to perform over 90% the same as any other 90-10 portfolio. And what that's telling you is that it is those macro allocations that are really dictating what your performance is likely to be in the future and how that's going to compare. So that fiddling around with a whole bunch of different stock funds is not going to really change your overall performance for the most part. What matters more is, are you 100% stocks, or are you 60-40, or what are you? And so I think that principle gets lost, and so that's why you see so much discussion over the stock part of a portfolio and so many different variations on that. What Jack Bogle is telling you is, like, if that's already reasonably well diversified, it's going to perform 90% plus. He says 94% plus the same as any other thing that somebody else provides, and the difference is going to be probably random. So don't get too excited about trying to optimize a stock portfolio, because it's a fool's errand, essentially. You'd be better off thinking about what the macro allocations are. And then the third principle we use is the Holy Grail principle, that when you are ultimately constructing and trying to do a diversified portfolio, you do need to analyze the specific correlations by number in a correlation matrix, and do back testing to figure those things out, because the word diversification is thrown around, and we need to hone in on that and define it as uncorrelated or low correlation. Too many people assume that diversification just means different, and that's not what it means, and it won't help you if you're doing that. There's also the idea that people think, well, I heard you need to be diversified, so I'm buying 6 different stock funds. Okay, you're not diversified buying 6 different stock funds. and you probably don't need it if you're in your accumulation phase, because the purpose of diversification is not to increase the returns of your portfolio. The purpose of diversification is to lower the volatility of your portfolio. So
it's a bit like creating a global portfolio where you buy like 1% of every country in the world, that, you know, as many as you can get. You know, it's much better to just sort of go with the global index that tells you that, you know, this country owns this much percentage, you know, because you're just missing out. You know, it's not as easy as just divvying it up, really. It's got to be some thought behind it. Yeah,
exactly. So that's probably too many thoughts, but those are my thoughts.
That's great. Well, thanks again, Frank. It's been a pleasure having you on. Would you be able to let our listeners know where they can best find you online to learn more?
Yeah, sure. I have a podcast. It's called Risk Parity Radio, and you can find that at Apple Podcasts or wherever you get podcasts. It's on Stitcher and all those other things. It's also available at the website, which is called riskparityradio.com, www.riskparityradio.com. That's spelled RISKPARITY, not ODY, radio. And I also hang out in the Choose FI Facebook group frequently. And you can find me there. But if you go to the website, it's a very simple website, but really all it's got there is it's got the podcast, and then it's got these sample portfolios. So if you're thinking about, well, what does one of these portfolios look like and how does it behave? We update those every week. And so we can see how they're performing through time and give people a sense as to what this is and why it works and what's different about it from other things. The other thing I do on that podcast now most frequently is just answer lots of questions. And then we also do analyze various asset classes. If you go to the podcast page there's a little index of the ones that we've talked about that include gold and Bitcoin and other things. And then you can go listen to the podcast where we talk about that and go through a 10-step question process to analyze the investment and then consider whether it's appropriate or how much would be useful to have in a risk parity style portfolio.
Okay, great. Well, I'll definitely include details to that in the show notes of the show. Thanks again, everyone, for listening. Really enjoyed learning in this episode. Such great information. If you do want to follow the podcast, be sure to subscribe and like on YouTube, as well as Twitter, which is at Superb Diamond RA or Superb Diamond RA. And if you have any suggestions of shows that you'd like me or anything you'd like me to discuss in the future, please send us an email at superbdiamondrange@gmail.com. But once again, thanks for listening and catch up with you again soon. Thanks. Bye.